Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com. Hi listeners, I have some exciting news for you. I'm hosting the virtual Invest Smart Summit on June 6th. We'll cover how to more effectively evaluate sponsors, markets, and deals. We'll have one of the nation's top tax advisors, Tom Wheelwright, speak. And wealth isn't only about money. We'll also have Sahil Bloom, the New York Times bestselling author of The 5 Types of Wealth, and the acclaimed thought leader and life strategist, Tim Storey, join us. This is an event you won't want to miss. Go to investsmartsummit.com right now so that you can live your best life. Today on the podcast, we have Chad Ackerman. Chad is the founder of CARE, a coaching practice dedicated to educating and empowering new and aspiring limited partners in the world of passive real estate investing. Chad co-founded Left Field Investors, which was later acquired by Bigger Pockets and rebranded to Passive Pockets. Welcome to the show, Chad. Can you start by telling the listeners a little bit more about yourself and what you do?
Hey, Gary. Yeah, I appreciate you having me on. Excited to be here. I was kind of that consummate limited partner investor. I was a W-2 guy for a long period of time in HR of all things, so wasn't even financially driven, if you will, and went out looking for that second income stream and stumbled into the space to find the syndication world and be the limited partner that allowed me to scale while I was still in my W-2, which just checked all the boxes for me. That I jumped in, I burned my 401k, I flipped it over into real estate. I ended up tying in with Jim Pfeiffer locally, and we started Left Field Investors, and that grew into something nice enough that Bigger Pockets was interested in talking to us. So it's been a journey. It's been a sprint. It feels like a little bit, but it's been a fun journey to go along the way of just discovering the space and then reaching out and finding new LPs and helping, kind of bring them into the world, show them what this space is all about.
Well, you guys did some great work at LFI, and leaving a corporate job after 25 years. I mean, that must have been huge to be like a full-time limited partner. Was there like, what broke the camel's back for you to eventually do that?
Yeah, a lot of it was the left field was getting busier and busier. But mostly it was because I had generated enough passive income that it left me in that spot that I had financial freedom to pick and choose. And I loved being in that seat. I negotiated with the company that I was with that I wanted to work back to 3 days. They did some layoffs, and I actually tried to negotiate to get fired and take a package and go. And they wouldn't buy. I was in too much of a segmented role that they needed me in there. But I negotiated down to work 1 day a week, keep full benefits for a period of time. And then ultimately it hit a spot that I'm like, it's just, I need to go do this other thing instead. So it was a great seat to be in. I mean, it's what we all strive for that are in W-2s that look at this space. I was able to make that happen for my own sake anyway. And it was a wonderful place to be for sure.
Yeah. Congratulations. And I hear so many people that want to do that, to gain enough or build enough passive income so they can leave their W-2 and do it full time. Obviously, a lot of people make mistakes along the way, and I think a lot of people are paying the price right now for a very kind of exuberant, end of 2021, 2022. What are some of the biggest mistakes that you've seen people make as an LP?
Yeah, I think there's been a lot through the years that I've been investing. My first mistake was not being structured with my goals and my strategies very well. I got excited about a shiny object, and I didn't know it, but I was really looking for cash flow. And I bought into a deal that was 17-story building in Columbus or in Cleveland, Ohio, that they were going to gut and redevelop into apartments from office space. And, that thing never cash flowed for me and ultimately ended up losing my money in it because of the construction loans. But so goals was the first thing. But then, kind of to the vein of me losing all my money in that deal, it was really digging deeper into the PPMs to understand deal structure, mortgage structure, what variables are really at play in a deal. I started in 2018, and you almost couldn't miss with a deal at that point in time. So it made me a lazy investor because I didn't really look at the deals as hard as I should. The last couple of years have taught us, the pain points I've been through the last couple of years have taught me to spend that time, do the due diligence that you're supposed to do. We jokingly say, we need to be active, passive investors is what we really need to be. It isn't passive until you get into the deal, and then you just kind of watch the reports from there. But a lot of it was just understanding the PPMs better, understanding where there was risk exposure, and whether or not you really trusted that sponsor to know what they were structuring their deals as, and could they follow through, depending on what the economy was going to do.
I love how you kind of laid out your goals to decide how you wanted to invest, and then cash flow was important, obviously. I don't hear a lot of people talking about PPM and how to read it. Obviously, it's very, very long. It puts you to sleep. What are some of the key things to look for in a PPM for a kind of a newbie limited partner?
Yeah, I always liked, you kind of have your core metrics of equity multiplier, IRR, cash on cash. I always liked the minimum break-even point, just to understand how much kind of give a sponsor had just in case something went wrong. But now, more importantly, it's kind of understanding the debt structure and what are they getting involved with from a mortgage standpoint to make sure they're watching the market appropriately. And are we going to see interest rates keep climbing like they have over the past couple of years? Probably not, but we didn't expect they were going to climb like they did when they did go up. So, it's just what lessons have operators learned from the past couple of years that maybe they didn't have in place 3 or 4 years ago? How have they learned from their mistakes that they made, and what are they doing to adjust going forward? But I say currently it's a great time to be a limited partner because those operators that have made it through the past few years have learned. If they made it through, the past 10 years and we went back even into 2008, 2009, all the better. There aren't that many of those, but it's just those that survived just gives you a better funnel to look at versus all the people that jumped into this in 2019, 2020, 2021, and then got exposed. Well, luckily they've been exposed at this point. So investments that are going forward, you don't have to look at those individuals because you see the red flags that come with them already. You can move on and find those that did well. Break a Day did well. Is a good example of an operator that kind of saw and learned and moved forward. That's the kind of operator I look for now, and there's fewer of them, so it makes it a little simpler.
Yeah, and definitely sensitivity analysis to look for in the offering, and then debt structure, and that's something we've learned a lesson too. Banks are giving you 85%, 90%, and you're like, oh, I don't have to raise so much money. They're giving you this at a ridiculously low interest rate, and your eyes get big, and you take it. And we've all learned that, it comes back to haunt you eventually. Most likely.
Good to have a little more hedge in there, probably.
Yeah, absolutely.
Yeah.
Is there a market that you are focused on? Is there an asset class that you're focused on right now?
I'm watching multifamily. I think everybody's watching multifamily pretty closely, but just to see if it's going to make its comeback when the timing is right. It's catching the falling knife. It's dangerous to do. I do think there's deals out there to be had. Honestly, one that caught my eye here recently was marinas. There's an outfit out of Connecticut that's looking at marinas. Marinas feels like it's kind of the self-storage of days gone by, where there was a ton of mom and pop, basically all mom and pop, and then it was starting to get syndicated. That one looked really interesting to me. But I'm a big fan of triple net lease work as well. Just again, cash flow, LP. I love the triple net lease model, industrial or commercial. I've been a big fan of those for a long time too. But I try to keep my blinders on and not look at too many shiny objects outside of 4 or 5 asset classes. But those are the ones I'm really kind of like looking at these days anyway.
And that's a really good point, because I think that's one of the biggest mistakes people make too. I hear a lot about diversification, and so they think operators are create that diversification or 10 different asset classes, but they don't have the depth of knowledge to really know what they're investing in. And that's where, as an LP myself, I've made mistakes by my so-called diversification, not really understanding the deal or what I'm investing in, but someone recommended it or sounded different, different than
Yeah.
what I've invested in. And that's where I've made a mistake.
Yep. Yep. We often say, beware of the good marketer that may not be a good operator. Don't get dazzled by the shiny, glossy pamphlet they send out to you. Do your due diligence. It is important to do. And, there are a lot of asset class, a lot of deals, a lot of operators that we felt really good about for years. And then all of a sudden something blew up, and they got into something they couldn't really control, and maybe I don't know. There's many different circumstances, but it's not that we're right 100% of the time by any means. Our advice is get involved in communities, multiple communities if you can, just to go get as much information as you can to educate yourself about these situations. Just find other people that have had interactions with these operators to get some direct feedback. Again, doesn't mean we're always going to be right, but at least you have a better comfort of understanding information for people that have worked with these operators before you pull the trigger on them. And be patient.
Yeah, absolutely.
I think FOMO is one of the worst things we can have in this industry. Be patient with it. One of our people in our community in left field, he had a policy that he wouldn't invest with the same operator for a year after he did his first one, just to kind of watch. And I think that's great advice, from a diversification standpoint, just spreading your risk. Take your time, be patient with it, and good things come. There is another deal coming around the corner, so you don't have to have that fear.
Yeah, absolutely. And that speaks to the great community you built at LFI, and which now became Passive Pockets. Talk about what you guys did and provided for LPs, because it's such a powerful tool to that community that you built.
Yeah, thank you. I appreciate that. So yeah, it was borderline selfish to start with, that we wanted to become better LPs ourselves. As we were looking in the market, there was a lot of information to teach you how to flip single family homes and that kind of work. There was a lot of information to teach you how to be an operator, but there wasn't a lot of information around being a limited partner investor. And so we just started pulling like-minded individuals together to try to just swap stories, educate ourselves off of experience and so forth. And we found there was a big desire for that in the world, in the public out there. That the more podcasts we went on to talk about it, the more people found us. And it grew from that standpoint, that when we sold it, we had a couple thousand people in our community, and very engaged group, very educated group. And we've always said too, that operators love an educated investor. Well, that's what we were trying to help with, is teach investors about the space so they could ask good questions, be educated when they went into deals, and then make better decisions, hopefully for their own portfolio's sake. But it was a great journey. We had a ball doing it. I love being a part of it. I learned so much from just running a community and being engaged with it. Still engaged with Passive Pockets, and it's growing. They're growing the community there by all means, which is what we wanted. We wanted to see the community survive and grow beyond the resources we had available, and Bigger Pockets seemed like a great fit. And so far it has been.
Nice. And now you started a coaching program. Talk to me about that. How are you helping LPs?
Yeah. So after I got done with left field and we got the transition through, I wanted to go back and do something else with the community. And I've always had teaching in my blood. My parents were both teachers. A lot of my family are teachers. And I found myself pulled towards this coaching. I went out, bought a franchise with Focal Point Coaching, got certified as a business coach. but I spun it back into basically called coaching and consulting, that I want to go out and introduce more LPs or really W-2 people that are looking to build another income stream. I want to introduce them to this space because I don't think enough people know about it. There isn't enough education out there about it yet. You guys do a great job. You have a great program. I want to keep doing the same thing you're doing and introduce more people to it. Bring them in, just teach them about it. I'm not going to raise capital. I'm not going to get into that side of things. So I just want to stick to the education side. And I get a thrill out of just talking about real estate with people anyway. Just like this, I get jazzed up about these conversations. I want to introduce more people to it and just show them there's another spectrum to this that isn't talked about a lot that has validity to it. There's real, I've made my journey. I got out of my W-2 because of this space. So I want to introduce more people to it. And so I'm designing some webinars, some workshops, some one-on-one coaching. Just depends on what the needs are of the individual that stumbles on my material. See where we go from there.
Nice. And obviously you don't have a crystal ball, but where do you think we stand right now as far as where interest rates are headed, where you think, real estate opportunities lie right now, or maybe in the next 12 months? What are you thinking?
I like to feel we're headed in a good direction. This current state of affairs seems like it's more volatile than we've had in a long time. I think I'd love to get this question a year from now and probably have a better idea then. Right now, I'm still investing. I got into a deal about a month ago, so I still find deals that are out there that are worth working at. Again, I'd rather have my capital doing something for me than just sitting on the sidelines too much. But yeah, it's hard to say right now. It feels like we got to be at about as low as we're going to get with this industry. But man, we got a ways to go still. I haven't seen enough positive signs that we're coming out of it yet. But it feels like it's not getting worse anyway.
Yeah. I feel like there's some more deals that need to be shaken out, but the cap rates that we're seeing on deals right now are really, obviously it's expanded for us, that we're seeing a good 20 to 25% expansion on the cap rate. So I feel like it's a real good time to buy, but
that's good signs.
Obviously time will tell.
Yeah. Again, I'm a firm believer you can find deals in any state of the economy. They're out there. Do your due diligence, figure it out. And again, it goes back to knowing your goals. What are your risks? What are your criteria for the metrics that you need to see? Spend the time till you find those. Don't pull the trigger before you're really happy with the deal. But I'm a firm believer you can find a deal at any time. You just got to do the work.
And I would even go as far as in any market as well. As long as that operator has been operating in that market for a long time and knows, and it can adjust their underwriting. But there's opportunity everywhere.
Yeah, I agree. The best deal I ever got into, the reason I got into it was because it was a smaller market, and it was the third apartment complex that this operator had bought, and he then controlled 20% of the apartment, the industry there in town. So I'm like, well, you've got a good firm pace of what's going on. And he ended up selling all three to a REIT. So it worked out really well. But that was my home run one of the home runs I've had that I lucked into it, but I liked everything that I heard about it because he was so familiar and knew the property manager, knew the construction crews he was going to work with. It just all fell into place. It just worked out really well. Look for those kind of situations. They're still happening. These operators are definitely fishing in the same ponds quite a bit these days. So, you can find it. Take your time.
Before you invest, is there any heck no's, like definite things that you would never invest because of a couple of different reasons? I'm curious if you have any of those.
My biggest thing, I'm a heck no right now on asset classes that are outside of my 4 or 5 that I've set. Beyond that, it's that I don't want to be the guinea pig for an operator. So as you had kind of said, if it was a multifamily operator for many, many years, and now they wanted to try office space, I don't want to pull the trigger on that with them. Not to say I'll never do it. I want to give them time. Go prove you know what you're doing. Maybe you hired staff to help with that has experience in the office space. I'm just not a fan of office still for the way the world is operating these days too. But, so there's certain things like that. Those are kind of 2 of my big ones that I stick to.
Nice. Well, Chad, thank you so much for coming on the podcast and sharing your experience as an LP in building a great community. Please tell the listeners where they can find out more about you and connect with you.
Yeah, that'd be great. Thanks for having me on again. They can come find me at my website, Chad Ackerman Real Estate, or look me up on LinkedIn. I'm out there quite a bit too.
Awesome. Well, this is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.